The key areas in terms of the future of alternative finance, which is all about, a noisy panel in there, which is all about origination. I want to go back to what we talked a bit about earlier, actually. It's already come up in the debate. One of the big issues seems to be that actually there's a lot of people, a lot of money waiting to come into the industry and all the different bits of the industry, but there's a wall of money coming in, and you may correct me if I'm wrong, Cormac, maybe there isn't a wall of money coming in, but there's all the money coming in, but there's a real issue around origination, yeah? Where's all these deals going to come from? And there does seem to be a real challenge around direct customer acquisition, which is around brand, which is expensive and time-consuming and takes ages to do. And then there's about working with intermediaries or actually collaboration. And in fact, what Gonzalo's just announced is an example of collaboration, because effectively, correct me if I'm wrong, RateSetter is sort of acting as an intermediary channel, I imagine, for what Syndicate Room is doing, and it brings people in. But if you don't crack the origination thing, you're not going to be able to scale up. That's the reality, yeah? So all that money's waiting to come in is not going to happen. Anna, what do you reckon? Where's the balance going to come? Because you must work with finance brokers as well, who originate stuff, and isn't that the future? You're just going to stick with the intermediates and not worry about building a brand, or are you?
Yeah, sure. So I'm Anil from MarketInvoice. We've done about 700 million through the platform. We facilitate finance against invoices, contracts, licenses. So when we started, actually, we thought that we were going to have the opposite problem.
Yeah.
We thought that we were going to have a lot of businesses coming to us,
Yep.
and actually it's going to be a real struggle to find the funding.
Yep.
Actually, we had the reverse.
Yep.
We had a lot of funding coming. And what seems to be very important is building a brand that is trusted by your end user. You've got to think about origination. There's no like one silver bullet.
No, exactly.
You've got to do a bunch of different things. Like different businesses make the decisions in different ways. They trust different people. Some of them talk to their accountant. Some of them go online and look at kind of price comparison or use tools or read content. So we don't want to be captive to kind of one origination strategy. So we're getting people coming through online through the website. We're getting referrals, so also free referrals from other business owners talking to other business owners, and we're also working with accountants and brokers. So we see a kind of balanced origination structure to get that right quality of.
Where do you think you'll be in 3-4 years' time? Do you think you'll be mostly intermediary?
So we were never really reliant on brokers in our history. We are, as our brand becomes bigger and more trusted, we're getting a lot more brokers and financial advisors and accountants who are wanting to partner with us and refer us business. So I would say that definitely is an important channel, but brand and direct and building a good visible brand is also very important.
Daniel, what's your take on this? A slightly different industry, you work in property, so there's plenty of origination, I imagine, lurking around. There's plenty of properties lurking around, but there's probably not the right kind of deals sometimes, I imagine. So that might be, what's your challenge?
Yeah, it's certainly a very different challenge. So we're accessing the existing secondary market, and we can scale up deal size quite significantly. So we started off with individual flats and houses, and we quite quickly scaled into institutional grade investment blocks. So we bought 42 flats in a single transaction recently. So the real challenge for us is equilibrium.
Right.
And Anil and I were just chatting about this. I think it's that's the real crux of the problem, in the sense that, or the crux of the challenge. If we know that week we've got X million of demand, we can source a property to balance, to be roughly level with that, and pace our pipeline. Now, acquiring investors, you can unlock material growth in quite a short space of time. Conversely, there's a 3-month lead time to us having an initial conversation on a deal and that ending up on our platform. So what we've found is, we might run a new TV ad campaign, find that we've got a wall of capital that's gone very well, and then all of a sudden everything's just fully funded. We do have a resale market that investors can go into, but again, that needs to be in equilibrium. If the primary market's fully funded and then premiums start to emerge in the secondary, that can also be challenging. So equilibrium is the...
And that's really interesting you mentioned about equilibrium, because actually it goes back to some of the issues we've raised from the very beginning of the day, which is about marketplaces. Marketplaces are supposed to be dynamic in their setting of equilibrium, but actually one of the issues could be that the marketplace might not be very good at establishing equilibrium. You might have an influx of investment come in, and then actually you're struggling for origination, and then years later you might have too much origination coming in, and you'll be struggling with the investors. So, and I thought that equilibrium exercise is almost instantaneous, but it doesn't sound like it is.
It's what makes marketplaces so hard. There's two sides
absolutely.
of two sides of the equation. You're not just selling something from your stock cupboard. You've got two sides of that marketplace, and therein lies the reward as well, because it's tougher to crack, but once you have that becomes defensive. So I think it's not a natural equilibrium. I mean, just because you've got more investors, it doesn't suddenly pull in more property. You need to go and source that property. Or if it's invoices, you don't want to have lots of guys waiting for their invoices to be factored, and you're not supplied them with the finance. So you've got to. There's an execution process on either end that is the platform's job to get right.
Yeah, I think that there's massive benefits from having a marketplace model, having different types of investors, have different risk appetites, have different specialties. But we've always taken the view that it's not just a free-for-all, right? We actually have a role, the platforms have a role in making sure that we put things into the right risk categories, that we educate investors on the risks that they're taking, that we surface the data so that they understand what they're investing in. So we've always viewed our role as intervening and policing and making sure that the marketplace functions. It's not just a seesaw. One day there's money, one day there's not. It is our role to ensure consistency, stability of funding.
So that's interesting. That's equilibrium. So that's equilibrium and origination as two issues moving forward. Cormac, what about data and benchmarking? That's another critical issue, isn't it? Because a lot of people look at the spectrum of products and they stick it within existing credit baskets, for instance, or loan baskets, and they sort of understand it. And it says they have to benchmark off it. And yet, with the absence of the exception of the Larry, there's very little, which of course we do with Liberum. There's very little benchmarking out there, isn't there? And that's a real problem. Do you find that with investors?
I think that's a very good point. I think there's a real gap in the market. I'm surprised you didn't ask Rupert that one, actually.
Because I know he's going to ask me.
I think it is. There's a real lack of comparability. If you look at the yields that MarketInvoice, Funding Circle, Lending Club, Prosper quote, they're all on a slightly different basis, and it's kind of difficult to compare apples with apples. So I think there is really a gap in the market for someone to come up with kind of a global standard for, say, a fully seasoned to maturity IRR type calculation. I'm not sure, the Larry kind of goes some of the way there, but doesn't quite go as far as it could, I think. But basically, I think we need that standard. And I think we also need to maybe have some measure of not just current returns, but also kind of through the cycle, average returns through an economic cycle, so people have some kind of idea of risk. But I think those would be kind of two innovations that would be quite helpful. I'm not sure if Rupert agrees.
Yeah, I guess my reflection on that is I'm not naturally a very patient person, but I think maybe I've learned over time, or maybe this most latest job has taught me, and this industry has taught me that a major factor here is going to be time, because it's going to take a while for A, the data to become available, and B, the data to be meaningful in terms of, we are looking at historic data. We are not seeking to put ratings on things on a forward-looking basis. And so we can really only provide you with valuable information once stuff's happened. And so, a key issue for us, I have no doubt, is that, actually, probably our business is fairly counter-cyclical, because it'll be only after the information has become way more valuable because there's been a downturn that people will figure out that maybe it would have been useful after all.
Talking about data, there's other data as well. I've always struck, I think it was a couple of years ago that Christian was up on the stage. He was talking a bit about the issues in property around fraud. And he was saying that's a really big issue. But data and actually the data and robustness of the underlying loans, data and robustness about fraud, that's another area of data. Because we've been talking a lot about data and returns, but actually data is also just about underlying loans. We had a dinner last night with a bunch of guys who work in the balance sheet lending space. We were talking about that. They were worried about risk in terms of fraud. That's a big challenge, isn't it? Because actually as this industry grows, you are basically just going to attract fraud. I mean, putting it bluntly.
Yeah, of course. Fraud exists all over financial services.
Yeah, absolutely.
It's not just in peer-to-peer.
No, but as you grow and you scale.
Yeah. So, we have a team of 6 data scientists out of 80 people at MarketInvoice, and data is crucial to our underwriting process, to our ongoing monitoring of companies. We're always looking at ways of plugging into new data sources. So integrating with e-accountancy platforms gives us access to more information that allows us to better price risk. So data is really in our DNA, right? That's really important for us. And absolutely it helps with with fraud prevention, sharing data. There are schemes as well.
So where are the new sources of data? I mean, now that you mentioned accounting invoice
that's
software.
That's one area that we're integrating now.
Anywhere else?
Well, there's also the banks are going to have to give up current account information as part of the Payment Services Directive. At the moment, banks hold on to very valuable bank account information for businesses, and there's no way of directly porting that into peer-to-peer platforms. But this new initiative will enforce them to have an API so we can actually collect bank account information of businesses really seamlessly.
Daniel, what other information, granular information, do you need? Because imagine you might also have the same problems with you might have problems with fraud. You might have problems with other things, other data that people need to get the granularity of information. Where are you looking for information from?
Yeah, I mean, when it comes to the underlying asset class, we're actually providing property, and what we do there is we have a third-party independent chartered surveyor that values that property, and then that valuation is on the website. So the key for us in terms of the transparency required for our investors is making it super easy to access the performance of all of those investments, both in terms of what's happened from a capital perspective, but also how did the income play out compared to our forecast. So, for example, if we acquire a building and we say it's going to have a 5% gross yield and a 3% net yield after costs, but we only deliver 2 because we've managed it really badly, well, that needs to be available on our website and be really clear. So the end customer transparency is not dissimilar, I guess, to showing a loan book, but the underlying assets easier to validate.
Yes, they are. But equally, though, the property is multidimensional in the sense that, it sits within the regional context, it sits in a local context, it sits within its own marketplace context. So do you not feel you're going to have to provide a lot more granular data on local trends? Can you not be plugging into the likes of the Zooplas and all that kind of stuff so that you can see in real time how trends are going? From my simple, naive view, that looks like it might be quite important from the investor perspective.
Yeah, so Zoopla data is driven by land registry data. We have an API and access to land reg data whenever you invest in a property on our site. You've got all of that data available to you. It's only a monthly index. There is no real-time daily pricing of residential property. So that's as good as it can get historically. Going forwards, there are third-party forecasts, so Savills, Knight Frank, JLL, they're the big guys that forecast on a forward-looking basis. It's not our job, and it creates an awkward regulatory risk for us to be producing that forecast, so we don't. And then the snapshot at a point in time are these independent third-party valuations. So that's about as granular as it's possible to get, and we do all of that.
I think it's really interesting that certainly how it's changed my perspective, the arrival of property models, because clearly it's different, allowing investors access to loans secured by property on the basis that property is an established secondary market with a wealth of history and data. That's very different. That's arguably easier, or there are some advantages versus trying to originate assets backed by consumer loans or SME loans where this is brand new. We're doing it for the first time. So on the one hand, I think it's really interesting and it's a real opportunity for these property guys to really inform what they're doing with the data that's out there. But the other thing it makes me think is that it actually highlights how our approach is incredibly simplistic. Ultimately we say if you originate using an online platform with a market mechanism, then it's online lending and we'll collect the data. But actually, increasingly, with these new models arriving on the scene, the massive variability in the underlyings is getting ludicrous. So it presents a challenge for our business that we're actually going to increasingly have to develop and inform better and actually signpost and make it clear this isn't all one and the same anymore. It might have been sourced and originated the same way, but the underlyings are becoming increasingly different.
Cormac, what are institutional investors looking for in terms of extra information?
I think institutional investors can typically get the information they need. They just kind of ask for it, and they're big enough that people kind of, they say jump, people kind of say, oh, hi, right? But I think for retail and smaller investors, I think there's a real gap, and I think AltFi Data could be quite kind of instrumental in kind of informing the broader market about the different opportunities out there. I think there's a real absence of kind of, call it, for one of the better words, sell-side research on alternative finance.
Yeah.
And it kind of ties into, I don't know if you heard Christian was talking earlier about a company called lendingwell.com.
Yeah.
So it's kind of a one-stop shop for peer-to-peer aggregator, if you will. I think there's a real obvious play between that and AltFi Data to try and engage with the mass market, basically inform the mass market, give them some comfort that there is some curation and due diligence going on in terms of looking at which are high quality platforms, which are low quality platforms, basically making it a lot easier for less sophisticated mass market to start to come into the sector. So both in terms of connectivity and also the research, and basically helping to level the playing field a bit, for retail, basically give them access to the same kind of analytics and information that the institutional guys have.
Looking forward now, what are the new kind of things that you'll be able to invest in new asset classes or sub-asset classes? So classic example, and in your area, there's invoices, but I hear a lot of talk around supply chain finance. A lot of people beginning to talk around that area. I'd be interested to hear your views, Daniel. But what are the new things that people should be watching out for that they'll be able to invest in your area?
So, I mean, before we came along, it was investing directly into invoices or buying fractions of invoices was something that wasn't really possible. You had to, the market was dominated by the big banks or independent, factoring companies who've been around for a long time. So we feel like we've really opened up a new asset class to investors. We extended our product by moving more into also contracts or regular companies that have regular contracts that pay every month up to a year. You can accelerate all those payments up into one upfront payment. Again, that's a relatively new way for businesses to access that funding and for investors to get exposure to that kind of asset class. And we're looking at a bunch of different, extending our product and increasing the scope and helping more businesses get access to funding through their receivables, through their invoices, and other assets that they have. Supply chain finance is a totally different kind of product.
Yeah, exactly.
We have looked at it in the past. There are some good things about it, but there's also some challenges about it. Banks have been doing it for the big blue chip companies for a long time. So I wouldn't say that we kind of want to get into that space, although at some point it might make sense to go to in a company and open up their whole supplier base.
I imagine the returns might be a bit lower as well because competition is very intensive.
Different risk return profile.
Yeah. Daniel, again, what in your space? I mean, I hear lots of people talking about things like co-ownership of properties. There's a couple of big American outfits, new outfits that are buying into residential property, sitting with the owner of the property and doing that form of resi ownership. Where's the next frontier in terms of asset class in your space?
Yeah, firstly, I think it's probably worth us mentioning that most of these things have been done before in a traditional sense. So we have to be careful how much of our own hype we believe. I mean, we're allowing people to invest in property online, but they were doing it in groups informally for decades previously.
Yeah, exactly,
and,
true.
Similarly, invoice financing is an existing model. Life tenancy is an existing model. All these things can come online. So I think as a theme, anything that's in the offline world has the potential to go in the online world, and I think we'll see that increasingly. And shared ownership you mentioned, it's a good example. We're working on launching a shared ownership product ourselves. And it's just an observation that the existing shared ownership model that's out there lacks liquidity. We can tweak it slightly to improve that, and then we can make it available on platform. And then on a slightly sort of tangent, if you like, there are other sort of weird and wonderful things that I just hear about. Whether it's a platform to allow you to invest in classic cars or fine art or so on. And I think one of the themes there is how scalable is that? Is it really going to be a big market? So I think you'll hear a lot about lots of really niche things, and I wonder how far that will go. But generally, as a main, I think it will be every single aspect of the traditional banking investing products that will move to an online model.
Cormac, where do you think the next big frontier for institutional investors are looking? Do you think it's going to be student finance? Because in America, it's a big one, isn't it? So far, I've done very, very well out in the States. We haven't really got it in Britain, have we?
That's a good question. It's tricky. I mean, maybe mortgages. I mean, that's a huge kind of credit vertical that hasn't really been attacked. I think the other one is, I think kind of one other frontier is the whole kind of revolving consumer credit card type product. No one's quite cracked the liquidity challenge around that, but as and when they do, I think there's a huge opportunity there. So I mean, just touching on something you said earlier, I think there's a big play for someone to kind of create a standardized data depository for the industry. And that's possibly something AltFi Data could work on. But I think if you go back 100 years, Charles Ponzi, I think, was one of the initial early peer-to-peer adopters. So he did his Ponzi scheme, and basically it didn't turn out very well for investors. I think there's a real risk that today we basically run if we don't put a data repository in place such that we verify every cash flow, to the extent that, it leaves the bank account of the lender, goes through the platform, reaches the bank account of the borrower, and we can verify on all.
So a kind of blockchain for alternative finance.
Yeah, it sounds like going to be a nice luxury. I mean, it may sound to some people like a luxury to do that, but I actually think that if we don't do it, we'll actually set the industry back 10 years, because it's basically inevitable, to my view, that we'll get, a Trust Buddy times 1,000 or a Uzaibo type, $10 billion fraud emerge if we don't put in place that kind of data repository. And it just strikes me that AltFi Data is potentially quite well placed to basically put that kind of, you could use the blockchain to do it, or you could basically just do it with old technology. But I think if we don't do that, the whole kind of non-bank financing sector inevitably will face a major crisis.
I just want to ask one last question, because you just mentioned the word bank, and it cropped up earlier on as well. Isn't the inevitable transformation that some of you are going to end up becoming banks?
We don't have any aspiration to become a bank.
Or even just a traditional financier, really?
For me, the concept of being a bank is a bit old-fashioned. I think that you can get to the same goal by doing things simpler than going and getting a banking license, taking deposits. So, we never even thought about going down that route. And I think even some of the new banks that are launching could actually do what they want to do without getting a banking license.
Mm-hmm. I kind of want to answer that question and the previous question all in one, if I may. It feels to me like online lending, alternative finance is a subset of actually an increasingly bigger phenomenon that's going on. So I'm just going to reel off a few examples. There's a massively disruptive mortgage business called Castle Trust, which has done like 300 million pounds of origination in, 2 years. Actually, second charge mortgages, massively disruptive influence on the mortgage market, albeit in a niche. One you hear in terms of innovation is potentially an SME overdraft product, which I don't know who's going to be the brave person to come up with that, but that's definitely an interesting round of innovation. In terms of receivables funding, I heard an example of an established business that is funding telco receivables, so interconnect receivables where a call's being made to somewhere remote overseas, and basically an overseas interconnect company is owed money by British Telecom, and they've got to wait 90 days to get paid a tiny amount of money, millions of times, create a receivable, lend against it. I think it feels to me like, why on earth would any of these guys want to be a bank? Because, there's opportunities going on all over the place, and they all seem to be being led by non-bank models, funded by institutions directly or funded by online platforms, whatever it may be. Who would want to be a bank?
Okay, well.